A lot of times, if you're going to go sell $1 million, $2 million worth of property that you've been sitting on, if you get all that in one lump sum, obviously we have a progressive tax system in America. You obviously hit a huge tax increase because you're in jump tax brackets for that year type of scenario, right? However, if you were to sell it from a seller financing deal, which means you're now being the bank, no longer legal owner, obviously it would default back to you just like a bank would. So there's still a repercussion aspect and a safeguard. But from that perspective, you were taxed, and most people don't realize this, taxed at a lower rate on interest than you are principal. And so again, you just go to a lawyer, say, hey, this is what we've worked up. They just do all the legal paperwork, the amortization schedule. Okay, what's your interest rate? You do it just like you would a bank kind of scenario. Mm-hmm. But in essence, the other person's making the fees and you're not paying fees to the bank. And so in this case, they end up making more money for two reasons. One, their tax bracket's going to be way, way less because you're not going to jump tax brackets as quick. You kind of get a steady income in that sense as a seller. But again, you're also making that additional money off the interest of you being the bank. And so you end up coming out, if you're willing to wait, 5, 6, 7 years, a whole lot more money at the end of the day and a whole lot less money you paid in taxes.